Today is April 25, 3:14 p.m. and in less than 1 hour, Google Alphabet will be reporting earnings after hours. And so if you have been following our videos, you know that we've been watching these unusual options. And so today we will be going over our earnings trade. And before we do, we want to also look at what unusual options showed up today on the last day. So let's get right to them. So at 11:56, you see this largest one that is expiring this week. So this is an earnings trade. You see 5,000 of them here. The bid ask is very tight, very narrow, just a penny wide. And then we'll also see this 107 strikes here. This is looks like a calendar spread, taking advantage of the volatility, selling that volatility. So what we are going to do now is look at that chain and focus on this April 28 one here. These April 28s are the ones that are expiring. And so when we look at that 96 strike, you'll see that right over here, there's 8,000 of the volume here. It's greater than the 6,000 open interest. So we know these are open orders at this 96. You'll also notice that the 100 strike, it's also, the volume is also very high. It did not necessarily show up on the tape, but our analysis of this is that this is quite a significant number, not only because it's a psychological number, but it is because of these unusual option volume here. This is a lot more than that 96, right? So what we think is going on here is they are buying the 100 strikes here, and that's what we are also doing. We are buying this, and then we are selling the 96 strikes. So creating a bearish put vertical spread. So you'll see here, our trade here, if you buy that and you sell that, and that's about, you pay about, currently the value is $70, right? So you'll see that it's a bearish trade. However, because the theta is quite large with the negative 17 and the vega is positive, we added on another trade to make this more earnings favorable. So what we did was, for our trade, we went to the call side and we took the 110s, which we've been also watching this strike price. As you'll also see, there is a larger volume here, but for the past few days, we've been watching this volume being traded and watching what the institutions are doing. And so we decided that we were going to sell a call spread. We were going to sell the 110s and then buy the 115s. You'll see our position there. So what happens is you sell the 110s and you buy the 115s, you get about a 65 or so credit. When we got our trade done, it was actually, we actually collected a larger credit. We got a credit that was very close to 70 for it. And then basically the debit on our put spread was also about the same. So we ended up not having to pay anything. The only thing is that you have to have a buying power of at least 500, because selling this call spread is 5 points wide. So it's a $500 capital required to sell a call spread. If you don't want to do this, though, you could just buy the put spread, but that's this higher risk because of the theta decay and the volatility crush after earnings. By doing this trade with that call spread, you'll notice here now our theta is positive, and also our vega is negative. So this is all very good for earnings, and we still have that negative delta for our bearish direction. So what this does is that if Google were to rally and go against our trade, we would not be at a loss, as you can see here. There is no loss here until it breaks 110, and then we start to have some losses. But even then, it's quite minor. We can cut our trade off, and so if it goes down, we can start taking profits right away. And so this is why we like this trade of selling a call spread, collecting credit, then using that credit that we get to buy a bear put spread. So this kind of a trade, it reduces our risk and allows us to profit or not lose at all. So essentially, if you look at this probability here, this mark here, this yellow line here, is saying that there is this percentage plus this percentage plus this percentage that this is going to all happen, that this price will be within this range statistically. And so there is a 11% statistical chance that we will be wrong. And so we like that close to 90% probability in our favor here. So that's why we like this earnings trade, taking on that Google bearish sentiment. But if it somehow does rally for earnings, which can definitely happen, it would actually have to rally quite a bit, all the way past 110. I guess break this, or even go up even higher. So that would be the only way to kind of lose in this trade, because of the volatility crush after earnings that we gain from the negative vega trade on this. And then we also have a positive theta. So since there is April 28 when these trades actually expire, if we let this trade kind of run, the theta will actually be positive and actually will help us recover our losses. If it does rally, this will go back up towards that zero profit loss line, and so that reduces our risk. Okay, so that's the trade we're going with for Google earnings. And if this was helpful, please smash that like button and subscribe if you haven't, and hit the bell icon. You'll be notified whenever we see unusual options. Take care, everybody, and good luck out there.